All right, folks, we're gonna get started here today. There may be other people who kind of trickle in, but we'll start the presentation here. So good afternoon, and welcome to today's presentation on life insurance for estate planning and wealth transfer. I'm Russ Austin, Associate Vice Chancellor for Plan Giving. It's wonderful to have so many folks joining us today from across the country for the first in a series of informational webinars designed to provide timely information and insights on a variety of financial, tax, and estate planning topics. Before we begin, I'd like to let you know that we are recording the program. If you would like to submit a question for the Q&A portion of the webinar, please submit through the Q&A function by clicking the Q&A button in the middle bottom of your screen. As a reminder, we'd appreciate if everyone could mute their microphone for the duration of the program. Last, should you have any technical difficulties, please send a chat message to Emma. The chat button is next to the Q&A button, and then you can click on the drop-down to select Emma's name. I think it's under WashU Tech Support-EB. It is my pleasure to introduce our keynote speaker, Tyler Horning. Tyler is a principal partner at TDC Life, an independent life insurance and estate planning firm headquartered in Ohio. TDC Life works nationally supporting professional advisors and their clients, including high net worth individuals and families, closely held family businesses, and professionals. The Office of Plan Giving at Washington University has partnered with TDC Life to add value and expertise to our life insurance gift program. Tyler has more than 15 years of experience in the life insurance industry and is licensed throughout the United States. He is president of the Toledo Estate Planning Council and earned a BS from Hillside College. He joins us today to share insights and strategies for using life insurance as a tool to create, build, and transfer wealth. Please join me in welcoming Tyler Horning.
Russ, thanks so much. I'm so excited to be here with everyone. I'm going to be sharing my screen, so let me just get that out of the way. So today we're going to be talking about life insurance for estate planning and wealth transfer. I'm going to be sharing with you just some background on me and my firm. We're going to be talking a little bit of life insurance 101, some basics as it relates to life insurance. We're then going to talk about problems that life insurance can help solve and the solutions that life insurance can provide. We're going to talk about using wealth transfer, using life insurance as a wealth transfer tool, and then using it in the context of charitable planning. We've all provided a handout that has some basics, that's some good background. It can be viewed while we're speaking here, or at a later date if you'd like to dive deeper on any of these topics. Many of the topics we're going to cover at a high level. If you'd like to dive deeper and have some specific conversations, Russ and the Plan Giving team or myself would be happy to talk about your unique situation. We've had some questions that have been provided in advance, and we'll be addressing those throughout the presentation. And I'll be speaking for about 45 minutes, and we'll open it up for questions and answers at the end. So again, Tyler Horning is my name. The name of my firm is TDC Life. We've been in the high-end life insurance space since 1958. And there's really three things that we help folks do. The first is we help them buy life insurance, long-term care insurance, disability insurance, other life insurance tools. The second is we help people manage portfolios of life insurance. Life insurance is not purchased as an event. It should be a journey. And once you purchase a policy or a number of policies, those policies need to be managed over time. We're going to talk about that a lot more. And then the final thing that we help folks do is we help people liquidate life insurance. For many reasons, you may not need life insurance long-term, and we help people think strategically about exiting their life insurance policies. One of the ways that people exit life insurance is something called a life settlement. We're going to talk about that a little bit later in the presentation, but that's a great tool for exiting a life insurance policy. So enough about me. Well, let's get to the topic at hand. So just high level, quickly, life insurance is a financial tool, and it has some certain characteristics that make it very useful in solving problems. One, it pays out cash at death, quickly upon death. whether the stock market is up or the stock market is down, or real estate is up or real estate is down, life insurance will typically pay out a fixed amount at death. That's called the death benefit. That death benefit pays out income and estate tax-free if the life insurance is owned and structured properly. Because of that, it's an efficient tool to help transfer wealth through the generations. And we're going to talk about some of those strategies in this presentation. And at the end of the day, somebody buys life insurance because they care about someone or something, and they'd like that someone or something to be protected using life insurance. So there's a couple of key words. Premium, that's the money that you pay for a life insurance policy. It goes to the insurance company. Cash value, that's kind of a savings vehicle that's inside of a life insurance policy. It's only available in permanent life insurance. We'll talk about that in a second. And then death benefit, that's the amount that pays out at death. So I've been talking about this idea of life insurance solving problems. And that's how I like to think about life insurance. And if you're using life insurance to solve a problem, you ought to be able to figure out the math. Someone ought to be able to show you the math on why a life insurance solution is better than an alternative. And a lot of the things that we just talked about life insurance, its tax-free nature, the fact that it pays out cash at death, make it a unique asset class that works differently than many others that are out there. So again, if you're thinking about buying life insurance, you ought to compare it to the other ways that you may be able to solve the problem. And it ought to be the next best alternative to be considered. So there's an evolution of needs for life insurance. Not everybody needs life insurance for the same reasons. Young professionals typically buy life insurance to protect their income earning potential. That is their greatest asset, their ability to earn income in the future. It trumps their home, it trumps their cars, it trumps any investment that they might have. And so a lot of folks, as they're starting out in their career, buy life insurance, and to a lesser extent, disability insurance, which is probably a topic for another day, to protect their ability to earn income in the future. As life goes on and somebody builds up their savings and builds up their safety net outside of life insurance, and they start getting closer to retirement, their needs for life insurance evolve. So someone that's financially independent may not necessarily have the income protection need that a young income earner does, but now may be thinking about using life insurance to transfer wealth that they've created, or create a charitable legacy, or many other solutions. You know, Allison asked in advance of this presentation, at what age or income level should someone start looking at life insurance? And really, I like to think about it, again, as a situation where it's solving a problem. So when someone has a family, they have someone that's dependent on them, someone that they care about, or they've taken on some debt, or started a company, or have some other reason that cash is needed at their death, that's a great time to be thinking about life insurance. The younger and healthier you are when you lock in a policy, the less expensive it's going to be. So there isn't a magic age or a magic point in life where someone should think about it, but it depends more on, do they have folks that depend on them and would need some protection if they died. Some people use it to pay off debt, to pay off a home, or pay off student loans, but that would be a time where people start thinking about life insurance. We had another question asking about how much life insurance does one need? And that also is very dependent on someone's unique situation. I would tell you, if you're a younger, income earning person, the minimum amount of life insurance that you should have is typically 10 times your income. That's a great place to start, kind of a rule of thumb. The maximum amount that an insurance company would be willing to sell you is 30 times your income. Most folks pick an amount somewhere in between those two numbers, but those are great places to start. A lot of folks would say, okay, I get it, 10 times my income. If I make $100,000 a year, that's $1 million death benefit. But what if I have some savings? So you might reduce that amount by savings that you have that would continue irrespective of you being alive or having died. But you might also increase that amount by student loans that you have, or a mortgage payment that you might have, or if you have multiple children, or in some situation like that. So typically 10 to 30 times someone's income as they're in that wealth accumulation phase is a good amount to look at. As you become financially independent, kind of at the other end of the spectrum, typically the most insurance that you can buy is your net worth. You can buy up to your net worth for personal protection reasons. If you have business needs, that would be in addition to that. If you have charitable needs, that would be in addition to that. But that's kind of the range of the life insurance that folks can buy. So let's now dive into specifically life insurance. So there's really two major types of life insurance. The first is called term insurance. That's the temporary stuff. It's very inexpensive. And the reason it's so inexpensive is you have protection for a limited period of time. Typically that would be 10 or 15 or 20 or 30 years. That premium's locked in over that period of time. And again, it's relatively inexpensive. I describe this kind of like fire insurance. You buy the maximum amount of protection that you can, low premium, but if you don't have a fire, you kind of have nothing to show for that premium that you paid. So there's nothing like a cash value. That would be something that we look at with permanent life insurance. So one of the most important features of term insurance, and if you have term insurance, you want to make sure you have this on your term insurance policy. That's called convertibility. And what that means is you can exchange the temporary term policy that you have for the other type of life insurance, the permanent life insurance, without any medical underwriting. So here, let me play through a scenario. So you have a 10-year term policy. You get to year 9, and God forbid you get diagnosed with cancer or some other sort of dread disease. Your policy will expire in 10 years, but now you have this dread disease and you'd like to keep the policy going on. If the policy is convertible, you exercise this convertibility feature, you get permanent insurance, no medical underwriting, they can't deny you for making that exchange, and you get to keep the policy for as long as you live, and you get it at whatever rates, whatever underwriting rate classification you got when you bought the term insurance. The premium's going to go up in the conversion because now you're going to the permanent stuff, which is more expensive, but they can't deny you based on any sort of medical issue. If you didn't have that feature, or you don't have that feature on the term insurance policy, I'd say don't buy it, because that's one of the greatest protections you have, is protecting your insurability. If you don't have a change in health, if you remain in great health and can go out to the market after your policy expires, you should. And you should go shop around among the insurance companies, and maybe, you buy a 10-year term policy. At the end of the 10 years, you buy another 10-year term policy, and so on, as you go through the process. Michael had submitted a question, and his question is that he has a term insurance policy that he can convert to this permanent insurance. And the question is, should he do it? And I'm going to answer that a couple of ways. So again, Michael, if you are uninsurable and you can't go out and buy any other life insurance, you absolutely should convert the policy and not miss that conversion deadline. If you are in good health, you should shop the market. And it may be staying with your current insurance company and doing the conversion, or it may be going to a different insurance company that may give you a better deal. So if you have to convert, what you convert into is something called permanent life insurance. There's many different types of permanent life insurance: universal life, whole life, guaranteed universal life, variable universal life would all be examples of types of permanent life insurance. This is a kind of policy you can keep for as long as you live. Typically, the premium's a lot higher than term insurance because the insurance company knows that you have the potential for keeping the policy until death. And often these policies build up that cash value, and the cash value can give you some flexibility in the future. and maybe a bit of a savings vehicle. And a policy can be designed to use life insurance as a savings vehicle. It's important that you pick a good, strong insurance company, because if you're 50 years old or 30 years old, this could be a 30, 40, or 50-year relationship with this insurance company. And so you want to make sure you have a good, financially strong insurance company. So as we've talked about, now we're focused just on permanent life insurance. This policy has a death benefit, it has a cash value, and it has a premium. So when you design a permanent life insurance policy, there's lots of different products you can use, but it really comes down to, do you need death benefit or do you need cash value? And it's a trade-off between those two. So if you buy a policy that maximizes cash value, typically it has a relatively low death benefit, and vice versa. And so it's important that you understand your goal with the policy and you buy one that that matches with those goals. What's unique about life insurance is you kind of get the death benefit or the cash value. You really don't get both. What I mean is, if you have a policy that has a high cash value and a low death benefit and you die, that cash value is really your money that the insurance company's keeping, but they don't have to pay you out much death benefit. What's better, if you are concerned about death benefit or are buying the life insurance for death benefit, is to buy a policy that has low cash value and a high death benefit. That typically gives you a better premium. If you really care about cash value, you want to minimize the death benefit as much as possible, because that is a frictional cost. It's an expense that slows down your growth of cash value in the policy. So it's important to know what you're trying to accomplish and then ensure that the policy that you get is designed to match up with those two. And typically you want to either go for death benefit or for cash value. If you try to do both, it doesn't really maximize the value. So we can't talk about life insurance without talking about estate taxes. And this will just be a quick rundown, a high level of estate taxes. So we live in a country that has a transfer tax system. What that means is, if you give money away while you're alive or at death, potentially it's going to be taxed. That tax rate is 40% today. So if you give money away while you're alive or at death, potentially there's a 40% tax on that transfer. But we have some weapons against that tax. One of those weapons is called an annual exclusion gift. That means you can give $15,000 away per person, per beneficiary, every year without paying any tax. So you could give anybody. I could give every person on this call $15,000 a year, no tax. My wife could give every person on this call $15,000 a year, no tax. So that's an important weapon against the estate tax. The other weapon is something called your lifetime exemption gifts. And today that amount is $11.7 million. This is a running tally of gifts that you make over your life or at your death that you can give without paying any tax. So that's per person, $11.7 million. So my wife and I could give away, $23.4 million, no tax. That amount is historically very high. Those exemption amounts have been as low as $1 million in the past. And there's a lot of chatter out there, and the new administration has talked a lot about potentially reducing that exemption amount or changing the way that our transfer tax system works. But most prognosticators would say that it's going to make it worse for transferring money without tax. So there are lots of tools and techniques that you can employ today to take advantage of this exceptionally high transfer tax amount. And you should definitely think about doing that, because if it lowers, many more people may have to pay estate taxes. I read an article this morning. The title was, "It's never too early to start thinking about tax reform." And I think that's exactly right. Planning today will help take advantage of opportunities and maybe prevent unintended consequences in the future. So one of the things that I've talked about is life insurance can transfer income and estate tax free. What's crucial there from an estate tax perspective, and in some respects, an income tax perspective, is that it's owned right. So the first way that you can own a life insurance policy is you can own it personally. The advantage of that is it's easy. You can change the ownership, change the beneficiary, put money into the policy, no problem. The problem with that is it's includable in your taxable estate. So it will eat away at that lifetime exemption amount. So today there's $11.7 million exemption per person. Let's say I had a net worth of $8 million and I had a $7 million life insurance policy. You say, oh, well, I have an $8 million exemption, I should be fine. Well, that $7 million of life insurance gets added to all the stuff that you own at your death when they calculate the tax. And that life insurance death benefit could be taxed under that scenario. So how do you prevent that? Well, the way that you prevent that is you own life insurance inside of an irrevocable life insurance trust. This trust, one, prevents estate taxes, but it also protects the dollars that pay out from the life insurance policy for your beneficiaries. And it can protect those dollars from estate taxes at their death and from creditors and predators and divorce. It is the absolute best way to own lots of different assets, but specifically life insurance. Another way that people own life insurance is often in their business. So again, for the folks that are kind of at the beginning of their careers and trying to build their wealth, there are about five different problems that life insurance can help solve. The big one is just taking care of folks that they care about that will suffer a loss if they die. And one that we're going to talk a lot about more today is number 5, which is charitable planning using life insurance. So a lot of folks, say, well, geez, I've saved, I've worked my whole life. I'm kind of at the other end of the spectrum. I'm financially independent, so maybe I don't need life insurance anymore. And sometimes that's true. We'll talk about that here in a second. But we'd say there's at least 9 reasons why people that are financially independent think about buying life insurance. A big one is to help pay any estate taxes that might be due. Life insurance provides liquidity to help pay the estate taxes. A new topic that is kind of the cutting edge is using life insurance for long-term care planning. A lot of the life insurance companies have created life insurance policies that allow you to spend down the death benefit to pay for long-term care. Another great reason why people that are financially independent might think about life insurance. We're not going to talk about all these topics today. We are going to dive a little bit deeper into that charitable planning one. But there are lots of reasons why folks that are financially independent still buy life insurance. They typically are just buying the permanent kind, the kind that will be there at their death. So if you come into a situation where you do need life insurance, it's really important how you approach the market. That will determine the pricing that you get. That will determine the options that you are presented. That will determine the solutions that are brought to the table. And there's really 3 main ways to approach the market for life insurance. And it really is a market. There's a negotiation that goes on when you buy this policy. And how you're represented in that market has a big impact on the outcome of your planning. The first option, and this is quite popular today, you may see it advertised on YouTube or websites or even on TV. These are online quote engines. These are websites where you can go and you can shop amongst multiple insurance companies to find a policy that you might like. The advantage of that is competition. And that's really important when you buy life insurance is having some competition to make sure you're getting the best option available. The disadvantage to that is if you have a more complicated planning situation, or you have a more complicated medical history, because they will look at your medical history to determine the price for the policy and if you are insurable. These quote engines don't have the firepower or the system to negotiate with the insurance company on your behalf. I'm proud to report when I try to get life insurance, I get a higher rated policy, which means a lower premium. And that's because I do have some medical conditions, but I negotiate with the insurance company to get a better rate. When I've used an online quote engine, which I've tested out in the past, I get standard rates. and they don't have the ability to overcome some of the medical issues that I have and get the better rates, which I know I can get if I went to market myself. So just something to be cautious about. But if you're young and healthy, it's really a great way, and have straightforward planning, it's really a great way to buy life insurance. The next is using what's called a captive agent. This type of agent represents an insurance company to a consumer. Common captive agents would be New York Life, Northwestern Mutual, Mass Mutual, Guardian Life. These types of companies have agents that sell their products to consumers. Again, those are good companies and a lot of fine people that are those types of agents. But typically when you work with somebody like that, you're only seeing one company's option and maybe not the full market and comparison. And the third option is to work with an independent broker. The broker represents the client to the marketplace and negotiates among multiple insurance companies for that specific transaction for the client. I am a little biased. That's what we are as independent brokers. And what we typically find is, even for the same client, if they have different goals with different policies, we may use multiple insurance companies to accomplish a total solution for that client. It can be done with all three, but in my experience, having some competition in the marketplace is helpful to get the best deal possible. So here are some questions, and we'll be sharing this the slide deck after the presentation, so I'm not going to read these, but these are some questions that you should ask whoever's going to represent you into the insurance market to make sure that you understand their biases, their accountability. Are they accountable to the insurance company, or are they accountable to you as the client? And just how the life insurance recommendation might fit in your overall planning, and they should fit hand in glove. Just some background on the life insurance market today. There's about $20 trillion of life insurance that's out there today, give or take $1 trillion or $2 trillion, depending on the year. But of that $20 trillion of life insurance, in our experience, 85 to 90% of those life insurance policies are the wrong type of policy, the wrong funding, the wrong insurance company. Something just isn't quite right. The wrong ownership, it's owned in somebody's taxable estate. And the reality of that is, it's really the most embarrassing thing about the life insurance industry is that there's this mismatch and people aren't getting good advice when it comes to life insurance. And we think why that is because 70% of life insurance policies are never reviewed after they're purchased. Again, I think that's due to the fact that 50% of people don't have active life insurance agents helping them with their insurance policies. The average age of the insurance agent is over 60 years old. And so you compile all of this, and it puts consumers in a position where the insurance company kind of wins. If people just keep paying their premiums into the wrong contract or the wrong funding or the wrong company, the insurance company is simply collecting premium on a policy that may not be managed properly. This is not all bad news. The good news is that if you manage a life insurance policy, you can win. You can take advantage of the insurance company, because what the insurance company knows is 5 out of every 6 life insurance policies never end in a death benefit. An example of that would be term insurance. You outlive the term insurance period of time. The insurance company collected premiums over all those years and never had to pay out a death benefit. Or you had a policy for a loan that you took out and you don't need it anymore because the loan's gone away. Or you decide you don't like the policy anymore, you cash it in. The insurance company knows that 5 out of every 6 policies never ends in a death benefit. So what that means is, if you're the person that keeps the policy until death, you get subsidized by the 5 others that paid premium but didn't collect the death benefit. Or if your need for the insurance is temporary, you ought to pay as little as possible as you can, so you're not overly subsidizing the others that end up keeping their policies. So how do you actually do that? You need to actively manage, you need to actively review your life insurance policies. You know, it usually boggles my mind that if somebody had an investment portfolio and the amount of their life insurance death benefit, they'd likely have an investment advisor making recommendations on how to rebalance and restructure their portfolio. Yet most folks don't have the same thought process with their life insurance. So I would absolutely recommend you talk to somebody that you trust, a financial advisor, a life insurance professional, and have your life insurance reviewed from time to time. Make sure that it still matches your needs. Make sure that there isn't something new or different that needs to be considered. Make sure that it is matching up with your current estate plan. And if you do that, you can win at the game of life insurance. So in that review and in that management and in that reprocessing, there may come times where you don't need life insurance anymore, right? If your retirement plan is fully funded and if you worked another day or didn't work another day, it doesn't impact your financial security, you may not need life insurance. If your estate planning is done and all the money's been transferred and everybody has the money they need and you've planned for the estate tax, you may not need life insurance. If your gifting and family legacy planning is complete, you may not need life insurance. And if all of your charitable wishes are fulfilled, again, you may not need life insurance. So what do you do if you don't need your life insurance anymore? Well, we would argue that there's at least 10 ways that somebody should consider leaving their life insurance policy that's smarter than just turning it back into the insurance company. And we don't have time to go through all these 10 today, but again, I would urge you to work with somebody that understands these techniques before you drop a policy. You could be leaving money on the table or missing an opportunity to take care of somebody that you care about with your life insurance if you just cash it in without getting some professional advice. So today we're going to talk about two a little bit more in depth. One is the life settlement, and the second is donating a policy to charity. So I've referenced this life settlement a few times. What is it? So for folks that are over the age of 65 or 70, and they have a policy they don't need anymore, they can actually sell that policy for cash on a market called the life settlement market. So there's about 30 institutional buyers who buy policies from folks that don't need their life insurance anymore. They pay the policy owner cash. The institutional buyer takes over the policy. They pay the future premiums and they ultimately collect the death benefit, but the policy owner gets cash today. So this is a transaction that's happening kind of all day, every day. Last year, we settled about $150 million of life insurance death benefit in the secondary market. And the total market is, about $8 billion a year of death benefit that gets settled. So there's lots that's going on in this market. You can sell the policy for cash. You can sell the policy for a paid up retained death benefit. So you don't get cash today. You just your beneficiaries get a portion of the death benefit whenever you die, or you can sell it for a hybrid, a little bit of both. But a really important and interesting strategy to be considered before you cash in a policy. So again, don't guess about that. You should have somebody review it and look at it and see if this might be an option for you.
Tyler?
Yes.
Hey, do you want to give just an example of what that might look like?
Yeah. Russ, you read my mind. So here's a great example of what that looks like. So this is an 82-year-old gentleman. His name's Gary, that we worked with and effectuated a charitable solution using a life settlement. So he had a life insurance policy that a $750,000 death benefit. The policy had about $135,000 of cash value. So if he just turned the policy into the insurance company, they would have cut him a check for $135,000. If he kept the policy, he'd have to keep paying a $30,000 a year premium. So he didn't want the policy. He didn't want to have to pay the premium anymore. And in this case, he went to his alma mater and said, hey, I don't want this thing anymore. Do you want the $135,000 of cash value? Well, the alma mater worked with us. We actually took the policy out to market, and we were able to sell the policy for $450,000 of cash value. So $450,000 came into the organization, and they were able to use that and kind of celebrate that gift while this gentleman was still living, and see the benefit of that donation. So you're going to get something less than the death benefit, but something in excess of the cash surrender value. And in this case, it was well in excess of the cash surrender value.
Hey, Tyler.
Yeah.
What happens if the individual decides they want that money instead of giving it to charity, or they're going to do it through a different vehicle to charity? Is that taxable to them?
Yeah, great question, Russ. So yes, if somebody did do a life settlement outside of the charitable realm, it is taxed typically at capital gains rates. So your premium that you've paid is your basis. Anything over and above your premiums paid is taxed at capital gains rates.
And so one solution to that, and actually I don't think we have a slide on this, Tyler, is having that settlement go to charity, that $450,000, and the charity using that money to create a charitable remainder unit trust for the donors that pays them for their lifetime.
Yep.
So in essence, you're taking an asset that is not producing an income for you and donating to charity, so you'll get a tax deduction for that. You could receive an income for life through a charitable remainder trust by using that funding to have the nonprofit create a trust for you.
You got it. What a smart strategy, Russ. And you're taking something that would be taxable if you did it personally. You're making that exchange tax-free, but also getting the benefit of the income going forward and doing something great for your favorite not-for-profit. You're exactly right. That's a good one. So what we're getting into now, and Russ did a perfect transition there for us, is how we can use some of these techniques and how we can use life insurance in the context of charity. And what's a bit new here is WashU in a big way is embracing some of these techniques, and candidly is at the forefront of some of these techniques really in the country of embracing life insurance in some of the more complex ways that can be used to do something great for the school that everybody on this call loves so much. So here's another example. This donor, Stan and Linda, were the insureds on this policy. They had a $3.5 million what's called survivorship universal life insurance policy. We haven't talked about this much, but there's a subtype of permanent life insurance, which is called survivorship life insurance. And what that means is it insures two people's lives, typically a husband and wife, and typically it's used to help pay estate taxes, because estate taxes are due at the second death in a married couple. And so in this case, they didn't need the life insurance for estate taxes anymore. So they decided to donate the policy to their favorite school. They got a current deduction, tax deduction for that donation for the fair market value of the policy. And then they donated future premiums on the policy and plan to do that until their death. Those future donations got an income tax deduction at the time, and were able to do something great for the organization that they loved. That was an existing life insurance policy they didn't need, so they donated it and donated future premiums. Here's a really smart strategy that we've been doing a lot with at WashU, where folks have money in IRAs or other retirement plans that they don't necessarily need for their personal financial security. Those retirement plans are some of the most tax inefficient assets that somebody can own. The reason they're tax inefficient is whatever's in the IRA at somebody's death will be income taxable to their beneficiaries. And if they have an estate tax to pay, will be included in their taxable estate as somebody calculates their estate tax. So what we ended up doing is saying, let's take this tax inefficient asset that you have, donate it to charity at your death because they don't pay taxes, and buy life insurance to replace that asset for the benefit of your family. And while you're alive, you're required to take what are called required minimum distributions from that IRA. And we can give some of that required minimum distribution to WashU during your life, and we'll use the balance to to pay the life insurance premium. And in this example that we did, it was a $5 million IRA account. And by adding in a life insurance policy and donating the IRA to charity at death, we were able to create $4 million of additional value for the benefit of their family than what would have been available had we not used the life insurance and donation strategy. Another is if someone's making gifts annually, taking a portion of those gifts and using it to buy a life insurance policy and kind of leveraging up those donations is a smart strategy that we've used quite a bit. Or another is if you have made a charitable commitment at your death as part of your legacy at death, you could accelerate and bring back that gift today, use the gifted money to buy a life insurance policy, which will pay out and fulfill the legacy portion, but do it with fewer dollars. An example of this, which we just completed last year with a healthcare system that we work with, is a donor had an $11 million commitment at their death. We came in and worked with them to restructure that donation. We said, hey, if you instead donated $3 million today, that would allow this organization to buy a $16 million death benefit on your life. And now instead of them getting $11 million at your death, they get 16, and you get a current income tax deduction for the $3 million donation. And at the end of the day, this hospital system got $5 million more in total benefit. And again, we're talking in $1 million amounts. This doesn't have to just be $1 million donations. It can work with much smaller donations. It can also work with much larger donations as well. But the concept rings true. If you care about an organization and want to take care of them at death, life insurance can be a tool to help fulfill that, and maybe do it with income tax deductible dollars today. And again, all of these techniques can be done with term insurance as well as permanent insurance. So if you have a term insurance policy that's potentially expiring soon, we should think about how that could be used in the context of donations. Just some key takeaways as we kind of come to the end of this of the prepared remarks portion of this. The things that I'd like you to take away from this conversation is life insurance can solve problems. So if there's some problem that you have that involves something that life insurance could help solve, it's often an effective way to solve that problem. There's really two types of life insurance: term, which is the temporary stuff, very inexpensive; permanent stuff, which will last for the rest of your life. It has cash value and some other flexibility. Cash value and death benefit are kind of mutually exclusive. If you die with a policy with a lot of cash in it, the insurance company gets to keep it. And so it doesn't often work well if you try to have a policy that's a jack of all trades. A big thing is not everybody needs life insurance. And there's an evolution of needs for life insurance. And that's one of the reasons why it's so important to review your life insurance over time. And if you do review it and you think about it strategically, there are ways that you can win at the game of life insurance and kind of, weight the decision in your favor. There's lots of ways to leave a life insurance policy that are smart. You just need to review it and think strategically about it. And then there's lots of good that can be done using life insurance, and specifically WashU is uniquely capable of thinking creatively about those types of gifts. All right, I'm going to take a drink. So Russ, I think we may have some questions.
Yeah, so first, thank you for the very informative and thought-provoking presentation. We have received a number of questions, but if you'd like to submit a question, please do so now through the Q&A function. I'm going to start out with a few of the questions that were asked prior to, and then Brigitte Toth, my colleague, will be asking the questions that are in the chat feature. So first, Tyler, Elizabeth asks, is there a mechanism for beneficiaries to receive monthly payments instead of a lump sum payment?
Yeah, that's a great question, Elizabeth. And There are some companies that actually will structure a death benefit as a monthly payment annuity for folks at death. And they actually give you a discount on the insurance to do that, because they know that, if it's a $1 million death benefit, they don't have to come up with $1 million right away. They can spread out those payments over somebody's lifetime. So there are some specific insurance companies that have that feature. The second option that you can consider is using what's called a single premium immediate annuity, also known as a SPIA. So this is a different type of insurance product that somebody can buy, and you take the death benefit, put it inside of this annuity, and that annuity can pay out an income for somebody's lifetime. That can also be done with WashU. There's something called a charitable gift annuity, where a donation is made to WashU and an income stream will pay out for somebody's lifetime. So there's some smart ways, specifically with thinking through with WashU, that we could structure something to get that monthly guaranteed payout.
Yeah, Tyler, we do some of those through testamentary charitable trust, where someone leaves an estate gift to WashU or an IRA to WashU, because obviously it's taxable to their heirs. And we create a charitable trust at death that then pays out their heirs for a period of years. So that's also an option that we do a lot with. Howard asks, what is the best way of presenting pre-existing health conditions to the broker and insurance companies?
Yep. Yeah. Great question. So I think Howard, the big point there is you need to work with a broker, and that broker needs to fully understand the medical conditions. The more information they can get, the better. And they should have an underwriting process that they take you through, which starts with understanding the conditions, gathering your medical records in-house before the first insurance company sees your medical records. Then they may ask you to get some additional testing, or go see a different doctor, or get a letter from your doctor helping the insurance company to better understand your medical conditions. Because at the other end of this transaction, there are actually people that are reading your medical records and evaluating how they're going to underwrite you, which is as much an art as it is a science. And so the more information they can have and the more comfortable they can feel with whatever the condition might be, the better result that you're going to have. But again, a qualified independent broker will help you to craft that package. And it's not to mislead anybody, but it's simply to make sure that all of the questions are answered. We have a saying in insurance that we want the underwriter to be nodding their head yes, and just keep nodding their head yes until they have an approval. If something isn't fully disclosed or something isn't fully understood in your medical records, that's when they start nodding their head no and getting conservative and thinking twice about what they're doing.
Great. Thank you, Tyler. Brigitte, why don't you ask some of the questions in the Q&A?
Great. Thank you, Russ. Tyler, one of the questions we received says, if you have borrowed a large amount of the cash balance and then die, how does that change the tax treatment of the policy payout at death?
Great question. So the answer is it doesn't change the tax treatment at all. What actually happens kind of behind the scenes is if you have $1 million life insurance policy, that maybe there's a $150,000 loan against the policy, your beneficiaries are only going to get $850,000 of cash, and the insurance company will internally pay off the loan at your death. So the death benefit will still be tax-free as long as the policy ends in a death benefit. If for whatever reason the policy runs out of cash value before you die, potentially you're going to have to pay tax on the loan. As long as it ends in a death benefit, the loan will be tax-free. That's a really great question.
Okay, thank you. We have another question. She says, we have a return of premium policy when purchasing whole life. Most whole life will give you the cash back at age 65. While you get your premiums back, how does that work for taxation?
Yep. So it's a great question. So if you're just getting your premiums back, that comes back tax-free. So in a life insurance policy, there's this concept called basis. What you've put into the policy is your basis. So if you're just getting your basis back, no tax. If you're getting something more than your basis back, that's potentially taxed at ordinary income rates.
Great, thank you. This question came in when you were talking about the life settlement discussion. This participant asked, if someone is not able to pay the premium anymore, they can sell it. They can sell the policy for cash?
Yes, and the answer is yes, with some caveats. So not everybody can sell a policy. You have to be, 65 or 70 or older, or have had a major change in your health from when you took the policy out. Those are kind of the broad strokes. There are certain types that don't really work that well, and certain other caveats. But I would absolutely say, if you remotely think you're close to a change in health or kind of that age range, you should absolutely consider a sale. And these buyers are getting more and more creative about what they're able to purchase. And so the box is a lot larger of what's considered for a settlement. And one other point, sorry, Brigitte, with a life settlement, much like buying life insurance, there's different ways that you can be represented in the market. And again, I think competition is a big deal, but especially in the life settlement market, there's kind of a right way and a wrong way to approach it. And I think, it's best to start with a good, reputable, independent life settlement broker as you're doing that. And that's something we do for folks, but there's lots of others out there that do it as well.
Great. Okay, and this is our last question. Can you designate a sole proprietor LLC or just an S Corp as a beneficiary? And would the LLC protect while the operating agreement is followed?
So the answer is you could name either one of the corporate entities as beneficiary. The LLC would likely protect. I'm getting into a range that's very situational specific. So I don't know all the background on all those, but the bottom line is you could make just about anybody or anything a beneficiary. There may be some tax implications on who it is or how it's set up. So I want to hesitate as I say that, but yes, an LLC or a sole proprietorship could be named as a beneficiary. Brigitte, I missed a question as I was going through this. We had a previously submitted question that was related to variable universal life and what happens to the cash value inside of a variable universal life policy. I had it written down, but we've talked about this a little bit, but variable universal life is just a type of policy that allows you to invest the cash value in the stock market, in some different mutual funds and bond funds. And with those policies, it works just like any other life insurance, where if you have cash value in the policy and you die with that cash value, the insurance company keeps it. If you access the cash value while you're alive, that reduces the death benefit, kind of like in that loan scenario. So I hope that helped with that specific question.
Great. No, thank you, Tyler. We did have a couple of people asking about the slide deck. And so I just wanted to mention that the recording and the slide deck will be available. We will be sending out a survey that will include links to those.
Great.
Thank you, Brigitte. I appreciate it. One last quick question, Tyler, and then we'll get you out of here. How has COVID impacted the life insurance industry?
Yeah, great question, Russ. So, It's interesting. A lot of folks would think, with COVID, there may have been a lot more deaths, which would put stress on the insurance companies, and that actually hasn't been the case. There's been some studies that have shown that a lot of people that have actually unfortunately passed away from COVID didn't own life insurance. So it's really had minimal impact on like the strength of an insurance company or having to pay out a lot more death claims than expected. The residual effects, though, on the insurance company are a few, and one is interest rates have continued to be low, and low interest rates are difficult for insurance companies. So we're seeing that impacting policies that may have some interest rate sensitivity. On the flip side, it's really forced insurance companies to get with the times. In a lot of regards, the life insurance industry is very backwards. The process is very manual and takes a lot of time. And so they've embraced a lot of technology and electronic signatures and some things that seem just like breathing for most of us, but the insurance industry hadn't really used. And for younger, healthier folks, it's become a lot easier to get life insurance. For some older folks or folks that maybe have some medical conditions that the insurance company might be uncomfortable with, they've actually limited amounts of insurance you can get or some of the conditions that they're willing to cover. So it's kind of been both ends of the spectrum, but it's been interesting to see how the industry has navigated this new world.
Great. Thank you, Tyler, for sharing your expertise with us today. If you'd like to contact Tyler or me with specific questions, our contact information is on the screen. Also, as Brigitte mentioned, we'll be following up with a survey about this presentation. Your feedback is extremely helpful in ensuring we are providing our donors and friends with webinars that are informative and timely. If you have questions or if you have suggestions for webinars, future webinars, please don't hesitate to let us know. Many thanks to all of our guests for joining us this afternoon. We hope you enjoyed the program and look forward to seeing you at our next webinar. I want to leave you with one of my favorite quotes about the impact of planned giving on a university. Planned gifts will mean the difference between the maintenance of a great university and the evolution of an extraordinary one. Please stay safe and well. My staff and I look forward to an opportunity to gather again, both virtually and in person when it is safe to do so. In the meantime, if you have questions or would like to discuss any of the concepts presented today, please don't hesitate to reach out to our planned giving office. Thanks, everyone, and have a great day.
Very well.